I want to talk to an investor and I say, hey, look, you're on this call with me. You obviously like self-storage. I'm going to tell you about the things that I don't like. I'm going to tell you what keeps me up at night. I'm going to tell you about all the risks. I'm going to tell you about how frothy this market's getting. I'm going to try to talk you out of doing a self-storage deal and then ask you if we had to go through a 5-year bear market where, these assets are worth less than we're paying and we're missing our pro formas. It's my job to make sure we can hold on to this asset, but how would you feel spending 5 years from me while this asset's underperforming? The telltale signs of a bad investor are the ones who get really scared about the short term and forget about the long-term vision.
Welcome to Alpha Bets, a weekly conversation where we discuss interesting companies and help you understand the investment thesis in about 10 minutes. I'm joined today by Ross Klein, the CIO of Changebridge Capital, Pat Connolly, a resident stock detective, and special guest Nick Huber, the founder of Bolt Storage and the Sweaty Startup Podcast. I'm Nathan Warden, and it's time to talk self-storage. Nick, why do investors love self-storage?
Frankly put, I guess the revenue and net operating income have exploded over the past 2 years. If you had a crystal ball 2 years ago and said, what's the best real estate asset class to get into? Some would argue multifamily, maybe industrial real estate, but the case for self-storage would be strong. We've had a really good run and it makes operators like me feel maybe too good about ourselves.
What do the unit economics of self-storage look like?
They're trading at anywhere from a sub 3.5 cap rate up to a 6 cap in small markets. We're operating at a 35% expense ratio portfolio wide. So for every dollar of revenue that we bring in, we spend about 35 cents. That includes management, property taxes is a big one, insurance, maintenance of the property, and so on.
And what kind of occupancy rates are needed to break even?
We generally operate about 80 to 85% economic occupancy and achieve those 35% expense ratios. So my math would be about 45% occupancy where we're break even.
It seems pretty low. There's no other kind of real estate that you'd be able to break even at 45%, right?
It's all relative because net operating income doesn't take into account debt service. And we have to pay up for these assets right now because there's a lot of investor appetite. You can make as much money as you want as far as a net operating income measuring stick goes. But when it comes down to it, we got to get a return on our equity. And that's the tough part.
After 2 years of just fantastic operating environment, I'm sure there's been a rush of additional capital. How has that impacted your ability to source deals?
It's made it way harder. The bankers control real estate, right? When the bankers give cheap debt, we can pay up. And when they give cheap debt 2 years ago and it meant 6 months IO or maybe 0 IO, 20-year AM, 4.25% interest rate, we can only pay so much. And now when we have small town credit unions offering 2, 3, 5-year IO full-term loans on self-storage at 75% LTV, we can afford to pay a lot more. So we've seen a lot of cap rate compression in the space. The hardest thing about what we do is source deals. You hear me talk on my podcast and Twitter about how easy and fun self-storage is. Now we have 3 full-time acquisitions folks. We invest hundreds of thousands of dollars a quarter into our pipeline. And it's the toughest part because for every deal we win, there's 4 or 5 groups just like us that do exactly what we do that might be willing to pay a little bit more. So it's tough.
And inflation is the topic that everybody talks about now, it seems. In your business, there's some price inelasticity, right? I already have my stuff in a storage container in a facility. You raise prices on me a few percent. It's not worth my hassle to go move them, presumably. But if interest rates rise as a result of inflation, I presume that's tough on your cost of capital. How do you think through that dynamic?
Yeah, it's a double-edged sword. I think if interest rates go up, that means that inflation is running and we can charge more. We can raise rents on a month-to-month basis. And yes, revenue management is the key to this business. It's what the REITs do really well. It's what the big players do really well. You rent a storage unit from one of these big guys, you're going to get a $29 per month rent increase at month 3, and they're going to keep raising rents on you until they want to be at about 93 to 95% occupancy. They're sitting 97 right now. So guess what that means? They're raising rents extremely fast. And so, yeah, when it comes to self-storage, we can combat that in some ways, but no, we're worried as anybody about a debt crunch, the bankers getting cold feet, about the terms on our loans, the interest rates on our loans. When those go up, the cost of capital goes up, and we very well may see a period of time where everything we're buying right now is worth a little bit less.
How much of your business model, though, is grow as fast as you can right now while rates are where they are? Given if rates rise, your competition has a harder time entering the market.
It's hard to set goals in our business of how much we want to buy. We bought $50 million of storage last year. We'd like to think we have the system built to buy 150 this year. Soft goal of 100 million, but really we have to take what the market gives us. We're not willing to overpay for storage. We're not willing to over leverage ourselves and risk it all, frankly put. So we're buying with a lot of equity at acquisition. That kind of hurts our returns, but reduces our risk. In real estate, it's all about risk adjusted returns. And we're looking to play the long game. We're not sure where the market will be 3 years from now, but we're pretty sure where the market will be 10 years from now. And our thesis thesis is remote management is the future. You look at the REITs, Public Storage, Extra Space Storage, CubeSmart, they have exactly 0 stores without a full-time manager, 0. So we have 44 self-storage facilities. None of them have a full-time manager. We have almost 40 employees. 20 of them are in the Philippines. 4 of them are in Colombia. The rest are spread out all over the United States. We consider ourselves pretty efficient operators without full-time managers. But do we buy as fast as possible? I'd like to think so. We're definitely not going to get too risky.
That makes sense. And as you think about your sort of geographic footprint, are there any markets where you think it's difficult for you to continue to grow given saturation levels?
We operate in a totally different, honestly, I would say totally different asset class from the REITs. Public Storage, Extra Space Storage, CubeSmart, Life Storage, they are chasing top 200 metros in the United States, mainly top 50 metros. They're building a lot of Class A storage facilities, which means 3 stories, climate controlled. New supply is coming online really quick. 2017, they said this development can't be sustained. Self-storage was really a risky proposition right now. And then they said also New York City can't keep building more storage, right? There's no more land in New York City. Little did they know that in 2021, mid-pandemic, they would put 20% of new supply entering the market that year in greater New York City. So the supply continues to come, which makes me a little bit nervous. But in my markets where we operate in small tertiary markets, we buy row facilities, drive up self-storage facilities, 80s, 90s, early 2000 vintage assets. And we don't really compete with a lot of new supply because no builder is going to come develop a self-storage facility in these towns where we're buying for $50 to $75 per square foot. So our wheelhouse is kind of finding these small towns where revenue and rents have not been managed. Maybe it was really hard to rent a storage unit at all in that town. That's when we can come in and we can do our work to find true market rent. That's the whole secret sauce of what Bolt Storage does.
Yeah, so I was actually wondering about these large publicly traded self-storage companies like Public Storage and Life Storage. One of the main ways that they grow is through acquisitions. So I was curious if you had ever been approached about it being acquired, but it sounds like these companies are in such different markets and they're such different sizes that wasn't really a conversation that you've had to entertain yet.
Yeah, there's a lot of other groups just like us that raise money and buy storage. So we could sell to one of those possibly. We're doing a lot of recapitalizations holding because, again, 10 years from now, we're pretty sure that these big players will have a remote management arm. We're kind of focused on being the best self-storage operators in the country and see how far that gets us over time. But yeah, I think it's a totally different ballgame. We have one facility with a lot of REIT competition in the near vicinity, and that's in Pittsburgh. They're building storage all the time, a lot of new supply coming on. We're spending $25 a click on our Google AdWords. Across the board at all of our other markets in our tertiary towns, we're spending $3.50. Customer acquisitions and competing with these REITs, I would rather compete with the group that doesn't know what Google AdWords are and uses a fax machine.
I saw online this 40,000 number where there's 40,000 storage units operated by mom and pops around the country. Is that accurate?
Yeah, our goal is to buy 100 of them this year. So there's a lot to go around. We can't possibly buy up all the mom and pop storage facilities in America. And I think maybe an average retail investor can go out and buy a $500,000 property and it can change your life, because if you manage it correctly, it could be worth $1 million a year later. On the other hand, there's a lot of groups just like us that go around and buy 1 million square feet a year or 5 million square feet a year. So the roll up is happening, but it's happening really slow.
What are the demographics of the average mom and pop who owns a self-storage facility?
They own 1 or 2 properties. They're obviously millionaires on paper because they have a self-storage facility that's worth $2 to $5 to $10 million in these small towns. They have 1 or 2 employees. They run the business themselves. They know a lot of their tenants and they're really involved in the local communities.
Older, younger?
Definitely, yeah. I'd say, I'm just making a wild guess here, but average age is probably 65 years old of a self-storage owner in America.
Okay. You see it across a lot of different industries, whether it's chiropractic or dental or home services.
Mm-hmm.
Yeah. There are opportunities across the board for these sort of roll-ups where the average age of the owner is in their mid-60s and this business is their retirement fund.
If you've made it this far, make sure to subscribe to the channel so you don't miss part 2 of our conversation with Nick Huber, where he gives a transparent look at whether or not he's achieving his aggressive business goals.